Good afternoon. My name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital, and I am honored to be joined by my former Green Street colleague from many years ago, Laura Clark, the Chief Operating Officer, and Michael Fitzmaurice. We'll call him Fitz going forward in this call for keeping it casual. He is the Chief Financial Officer of Rexford Industrial. We have a little presentation up on the screen here. We'll kind of go through the presentation. We have questions teed up as well. And should the audience have any Q&A, please feel free to submit those questions along. In addition, if you're watching this replay down the road, feel free to send us a message if you have any questions, and we'll make sure we can get the questions answered for you. So with that, let's jump into Rexford. Quite possibly one of the most unique industrial REITs that's out there, for the reason that they are fully 100% leased in Southern California. That's the market they care about, SoCal, which is the fourth largest industrial market, according to the company. When you look at the story, they own 51 million square feet across 420 properties in the market, showing a 13% 5-year FFO per share growth on a 5-year CAGR basis. 15% dividend share growth, which we're definitely going to get into because we focus on dividend stories here. And, this is a great slide from their investor presentation. This talks about their map around their Inland Empire, Southern California exposure. And I'm a big believer of the picture telling 10,000 words type of story here. But one key takeaway, if you look at all of these numbers here, is it's about a 5% vacancy rate across that millions and millions of square feet that they own. One key interesting focus here is their differentiated tenant base. They do a really good job presenting this pie graph here, looking at their tenant makeup, where more than half the tenants are exposed to manufacturing, warehouse, transportation, and wholesale trade. And when you look at their third quarter financial highlights, as they were one of the first REITs to report during third quarter earnings season here, cash NOI growth up 6%, effective NOI growth up under 3%, 60-cent FFO number up 1.7%, and some really good numbers here looking at year to date results here, especially highlighting the over 7%, 7.5% total NOI growth. One key focus here is the redevelopment, repositioning of the portfolio. And it's more importantly, it's kind of looking at where this is going to go. So we will be touching upon this, but the company is obviously very active on the redevelopment front. You look at some of the transaction activity. Now, I recall way back in the day seeing press releases almost every single day from Rexford when you guys were wheeling and dealing all the time. Now, with such a big portfolio, I know you get a little bit more select in the transaction activity, but 3 dispositions in the third quarter, 6 year to date, raising about almost $200 million in proceeds this year. The key for shareholders, though, is what drives shareholder value. How do you create value? And they really highlight, and we're going to go into all of these different things, but looking at the capital allocation, the leverage, the liquidity, more important, the long-term durability and resiliency, especially of the world of industrial. And they look at all these different levers to pull as far as how to add value, key being obviously contract rent increases, the capital recycling and disposition. On the other, share repurchases, obviously something that's really kind of in vogue here. And then obviously you look at all these things and how it uses to produce FFO growth while cutting their leverage here. And again, looking at what they've done in 2025 as far as cost initiatives here. And obviously, again, looking at how that carries into the future, because I know every single company, not to tell Mike how to do his job, but obviously every company focuses on what do we do to grow our revenues, cut our expenses, maximize our NOI growth, and to pay out that to shareholders. So these are some of the ways that they've utilize their capital allocation proceeds here, which we will go into. Share repurchases, we've discussed that briefly here. And again, one big focus that we're going to talk about is obviously when people talk about the world of REITs and commercial real estate, it's, oh my gosh, this wall of debt that's coming due, this huge debt maturity ladder. And obviously, we do see this 2027 piece that's coming due a couple of years down the road, but we'll get into that as well. So, with that, let's take off this presentation for the time being. Good to see you guys. And why don't we just jump right into it? I think the first question is, obviously, we're not going to wake up tomorrow morning and realize, hey, Rexford put out this press release. They're now going into Baltimore or into New York City or whatever it is. You guys have been bread and butter SoCal from day one. Don't see that evolving. What is it about Southern California? I guess being the gateway to the West with the foreign boat traffic coming in from Asia and other places. But what is it about Southern California? More importantly, how could you, if you had your little crystal ball here, how would you see that evolving in the future?
David, great questions. There's a few embedded in there, but I just first want to thank everybody. Thank you for hosting us, and thank you all for joining us today. Rexford, as you mentioned, and you did a great job, by the way, going through the presentation. We may just submit all the questions to you. Rexford is 100% focused in Southern California. And so your big question is important. It's why? Why would we be focused here? You mentioned this is the fourth largest industrial market in the world. That's behind the US, China, and Japan, and then you hit Southern California. So we're in the infill markets, which is where we focus. We're about a 1.7 billion square foot market. Today, Rexford owns about 50 million square feet, so actually less than 3% of this market. So I'm sure we'll get into kind of what that opportunity set looks like as we move forward. But what's really unique about this market and the infill market is the supply and demand dynamics here. We serve our tenants, because of their infill focus, really are serving the regional consumption base here in Southern California. We are the 11th largest economy in the world. We're larger than we're larger than almost every other country in the world besides 10. And we have a population base of over 24 million people. You mentioned we're the gateway, to the Asian seaboard, and obviously the cheapest and fastest way to get goods from the Asian countries to the United States. Add to that the demand dynamics, the supply dynamics of our market. Our infill markets are largely fully built out, meaning there's no available land in which to develop. And so as we look at the dynamics in terms of not having available land and then the high regulatory environment around any additional redevelopment or development in our market, our portfolio is uniquely positioned. And then the last thing that I'd say is really important, it's certainly we have really favorable long-term, intermediate and long-term supply and demand dynamics. But really at the core of why Rexford and why Southern California is the business model, which is how we create value. And this market is more than 50% of this market was built prior to 1980. It's a very fragmented ownership market, largely owned by individuals, families, partnerships that haven't invested in their properties over time. And so many undercapitalized and undermanaged properties. And our business model is pretty simple. We go and acquire those properties. We identify those opportunities largely through off-market or lightly marketed transactions. And then we go and we reposition those assets. We improve the functionality and quality of those assets over time that allows us to drive higher rents. And then at the end of the day, drive shareholder value and shareholder returns. And so this market and the opportunity set in the market uniquely positions us to be able to do that and drive outsized growth, which you've seen in the FFO per share CAGR that you mentioned, as well as our ability to drive dividend growth.
I got two follow-ups. Number one, I did an interview with Dan Leder, the new incoming CEO of Prologis, a couple of months ago for our 5 and 5 CEO interview, which you had done one with us several months ago as well. Thank you. In our conversation, Dan had mentioned in calendar 24, $3.2 trillion of goods flowed through their properties, which represented 2.9% of the global GDP. And I'm looking at that slide on your presentation where, again, we talk about your map. And if I'm looking at this correctly, $2 trillion of product flowed through your properties in 2024. Is that correct?
No, that's just that's the overall that's the overall market.
The overall market. Okay,
Yeah.
of that area.
Yeah.
Okay.
Yep.
But
Yep.
still,
So
it
that's a
tells
lot
you
though.
how important that is
Yeah. Yeah.
when you look at the pies. Okay, very
Yeah,
interesting. All right.
exactly. Exactly.
The second question you briefly touched upon, and I want to unpack it a little bit more. Of this total pie that we're talking about, approximately what percentage would you say is still mom and pop owned? That is under owned, as you said, or underserved, or would be better off being run by a more well capitalized, well oiled machine operator like you guys?
Yeah, we would garner that, you know, more than 2/3 of this market is what we would say is non-institutionally owned. Somewhere
Wow.
between you know, a quarter, you know, maybe give plus or minus is institutionally owned. So the remainder of this product is owned by, you know, those owners, generational owners of those properties where they've been handed through over time. Many of those, and truly that's the generational shift is really, which is just occurring in our market, is the biggest opportunity for us, because in many cases, you know, our industrial market was actually developed and formed post World War II, and many of those, you know, many of those owners, you know, you're into your second and third generation of ownership, and those owners and those families and those partnerships, you know, they have different motivations from a financial perspective and how they're thinking about their real estate and ownership. And that's truly the single largest driver of our opportunity set and future growth.
We're talking like 1970s, 1980s vintage type properties.
No, yeah, I mean, look, I can take you back to the 50s and 60s, actually. You know, if you think about the 1.7 billion square feet, about half of it was developed prior to 1980.
Wow. Okay. Very, very interesting. So obviously, with that shift, it may warrant change in how your portfolio changes as far as your tenant base is concerned. Because you buy this property, guess what? This is a, you know, a construction tenant. Got now your percentage of that allocation would go up. So I guess thinking about how your differentiated portfolio kind of builds your base of growth, again, maybe looking at this crystal ball, do you see a shift maybe from, let's say, warehouse and transportation towards retail as we see more last mile type stuff pick up? Or, you know, I guess, how does the portfolio tenant industry sector breakdown potentially shift over time?
Yeah, I think one of the really unique drivers of our market and what positions us so well is we're not driven by one or two or three different industries. When you think about the size of the economy that we have here, every industry, every business sector that needs to serve this size of an economy and population base has to be located here. You can't serve this population base outside of this market, given the density of the market, the size of the market, and quite frankly, the logistics within the market. And so when you think about our tenant base, it is incredibly diverse, which positions us really well, right? Through cycles and through different industry cycles. And so when we look at the overall breakdown, you know, I don't necessarily think that you're going to see material shifts in terms of what our portfolio breakdown is from an exposure perspective. Certainly warehousing and logistics will continue to be a key driver, right? Certainly as you look at, you know, what are those businesses that need to be able to get those goods to the consumer and to the businesses here in Southern California, they're instrumental in that. But other sectors and drivers like food and beverage continues to be very strong. Think about when you think about the population base and the need to serve the overall population base. You mentioned e-commerce, you know, that need to be able to be as close as you can to that first mile and last mile zone of distribution continues to grow, because there's a great need to continue to get goods in the hands of those consumers and businesses sooner. In many cases, we're seeing within 30 minutes, maybe, of an order time. And if you've ever driven in Southern California, you'll realize that sometimes driving a mile can take you 30 minutes. So if you have that need and that need continues to grow, then you're gonna, those warehouses that are in and amongst the consumption base become that much more important and valuable. And then a couple of other sectors I'll touch on, which I think are really important. One is construction. You mentioned construction, the construction materials, services, trades. Construction historically, right, can tend to be more of a boom and bust, right, through cycles. And that was an industry, those types of tenants, and historically we had stayed away from. But what we've seen, because there's a great need to add housing to Southern California, there's significant state mandates, there's mandates within the municipalities in which we operate to increase the housing stock by nearly 20%. And so in greater LA alone, in the urban areas, that's 1.5 million housing units. And so when we think about the tail of demand and how long it will take to develop that, we've seen a continued increase in demand from the construction trades and materials, et cetera. By the way, that's great from a demand perspective for our warehouses, but it does some other great things for us too. We will continue to see further industrial supply and other commercial uses taken out of the system and converted into housing. We've seen that over the last 15 to 20 years, and we expect for that to continue. So go back to where I was talking about supply. We believe that you'll continue to see that supply converted into residential uses because there's no available land to develop that residential. And then the other great thing about bringing in housing is you bring in more consumption. And again, our tenants are focused on consumption, so that should drive further demand. So we're continuing to see great increase in demand from that sector. And the last one I'll point out more recently is we've seen an increase in demand overall from those tenants in the aerospace, defense sectors. And that is currently another significant driver of demand. But we're super fortunate to be in a market where we have many drivers and sectors of demand.
I'll tee up a two-part question for you. So you're giving me such good stuff here that it's leading to more questions and got my hamster wheel spinning. If you ask any retail REIT, okay, not you guys, retail, different sector, hey, any tenants on your watch list? There's always tenants that are mentioned on a watch list. Now, my question to you isn't necessarily, hey, what tenants are on your watch list? But it leads to part two of the question, in that one constant headline we see every single day is about tariffs. So I'm going to tee it up of, is Rexford exposed to tariffs? But number two, how does Rexford think about its tenants and potential tariffs of incoming product and let's say the ability to pay rent on a long-term contract? Because again, you guys aren't doing leases year to year. You have a multi-year lease term in place with rent hikes in place with customers already. But how do tariffs to your customers potentially impact that rent stream coming to you guys?
I'm going to pass that one to Fitz.
Yeah, I mean, I can start with the tenant health question because I think that's important. And both Laura and I come from the retail REIT sector, so we remember all those headlines. A new tenant every day declaring bankruptcy. But it's dissimilar to that here at Rexford. I mean, our watch list today, David, in size is about 20 tenants. It's been about that same size, sequentially year over year. It's been pretty consistent over the last couple of years. And look no further than the results. Bad debt results for this year have been about 30 basis points or so of our revenues. Specifically in the second and third quarter, bad debt was effectively zero. So the cash flows are absolutely resilient, have shown resiliency. You could also look at our retention ratios in terms of the existing tenants that we are keeping within the portfolio. That's been between 70 and 80% all year long, which is above historical averages. So our tenants have been very sticky despite the tariff headlines. I think where we see the tariff headlines impacting tenants, it's more on the expansion of our tenants or relocation from other buildings to our buildings. So it's more on the new tenants side of the coin that we're seeing some slower decision making. And I think we saw that quite a bit in the first part of this year after Liberation Day on April 2nd, where there was a slowdown. We only did about 1.7 million square feet of leasing activity in the second quarter But then you saw that pick up significantly, almost double in the third quarter, which is really just a function of some pent-up demand and some improving fundamentals. Now, we're not ready just yet to call an inflection point by any means, because market rent has still decelerated. It decelerated about a 1% quarter over quarter from second quarter to third quarter, which is less than what it did in the prior quarters. So we are encouraged by that. But what we need to see is more of a trend line on leasing velocity, and we do need to see market rent stabilize until we can kind of call that inflection point and move forward and have a little more confidence around the market fundamentals. It's a little bit foggy still, and so we've chosen to slow down a bit on that front.
You mentioned something interesting about Liberation Day. It takes me back to April. I was at the NYU REIT Symposium with a bunch of your fellow REIT CEO and executive peers. And I'm not going to mention the couple of CEOs I chatted with, but I, asked them how are things going around Liberation Day, and I got literally the same word for word response from three different CEOs. Dave, here's the story. Take Liberation Day -1, Liberation Day +1. Let me tell you what didn't change. My earnings didn't change over these 3 days. My FFO didn't change over this 3 days. My dividend didn't change over those 3 days. But yet my stock price is down over 20%, 30% since this news is broken.
Mm-hmm.
What does the public know that I don't know when I'm the one sitting behind the desk here and I'm the one privy to all the information? I see the deals. I know what's happening. And yet the person on the other side thinks they know more than I do. Basically what they were saying was the market's too quick to react. We don't have any evidence of this. Nothing has changed fundamentally for our company so far, but yet our stock price is in the tank. And I think it goes back, and you've hammered on this several times already, it goes back to fundamentals. You have no control over your stock price. What you can control is the fundamentals in the story. And so when you say that you have your same watch list, you're seeing the same issues, your bad debt number hasn't gone up, all these different things means by and large fundamentals are pretty sound. And therefore, I'm not saying, of course, everybody wants people to buy their stocks and everything, but obviously when you see the stock react emotionally versus fundamentally, obviously it raises questions. All right. So
and I would agree, by the way, I would agree with those three CEOs, by the way. I mean,
that's well said.
At the start of the year, we laid out our top and bottom line growth, and we're going to finish, probably just above what those expectations are. So we're doing exactly what we said we're going to do at the start of the year, despite all these fits and starts with macro headlines.
So when I talk to advisors, investors, et cetera, it's like your job as a management team is to put the blinders on. Mm-hmm. Ignore all the headlines and all the stuff that's being said out there and focus on the company, focus on the operations. That's what your job is.
That's what we do. We often say control the controllables, and that's what we've done thus far this year.
Yeah, and for us, it's been focus on executing the business and focus on mitigating risk, and importantly, focus on adjusting, how we're allocating capital given the overall environment, and that's what you've seen us execute on this year.
Well, let's talk about that, because you briefly talked about some of the sectors that are driving your demand, but maybe talk about some of these capital allocation strategies. Do you want to highlight one or two in particular that, frankly, let's say is driving earnings growth or dividend growth, if we can get into that a little bit?
Yeah, sure. I can jump in there, and Laura, maybe after my remarks, you can talk a little bit about the disposition market. But I think it's important to share with the audience, what our capital allocation framework is, which ultimately then drives value for our shareholders. And our priorities today, David, are aligned with the market realities. There is some fogginess in the market conditions within Southern California today, and our cost of capital. And our priorities today, given those two dynamics, are accretive capital recycling and selective repositioning and redevelopment. And both, have driven FFO per share and NAV growth this year. Though that's the focus of our framework, is to drive those two metrics and generate the highest risk-adjusted return while maintaining a very low levered, high liquidity, investment grade rated balance sheet. So, for example, the selective repositioning and redevelopment this year, We have had great progress around that front. We've stabilized about 14 projects or so, 1.5 million square feet. It's going to contribute 27 million of annualized NOI. We have an additional 65 million annualized NOI behind that. And these are returns that are well into the double-digit return spectrum and that from an incremental basis. So really driving nice FFO and NAV per share growth. And then secondly, accretive capital recycling. We're taking advantage of a market today where we're achieving premium pricing in the cap rate range of low 4%. And redeploying, we sold about 190 million or so of dispositions, and redeploying about 150 million of that into share repurchases, buying back Rexford stock at about 38 and change, which is a super accretive and great investment for the company. And that's generated about 200 basis points of accretion to FFO in addition to being accretive to NAV. So those are the priorities today, and we've really showcased and demonstrated a lot of success against that. And likely that will be the blueprint as we move into 26 as well. But maybe Laura, why don't you talk a bit about the disposition environment and the type of buyers that we're seeing and being opportunistic with?
Yeah. In terms of the overall disposition environment, it's been a very low transaction volume year for Southern California, just overall. We're probably kind of in, if you look over the last decade, one of the lowest transaction years that we've seen. So it's not a very active transaction market, but all that being said, we are finding pockets where there is demand, and where we're seeing a lot of demand is actually in the owner user market. And when you think about how owner users value properties, they're not necessarily valuing properties in the same way that we do as institutional owners on a cap rate basis. They're taking into account depreciation and tax benefits, their ability to fix their costs long term from a real estate perspective. And so they're paying premium valuations. And so to the extent that, we've been able to capture, that demand, we've sold 6 dispositions as is up on the screen, about $188 million worth of properties at a 4.5% cap rate. And so as Fitz mentioned, being able to redeploy that very accretively into share repurchases, as well as our repositionings and redevelopments, which are our highest yielding, best use of capital today. I think importantly, kind of taking a step back, when we think about capital allocation and why we're focusing where we do, right? Why are we focused on repositioning redevelopments, driving this accretion through share repurchases, et cetera. For Rexford, going back to what I talked about earlier, our business model is founded around how do we create value, right? And how do we do it in a differentiated way by taking these buildings, increasing the functionality and quality of these buildings that allow us to achieve outsized growth. And so just to put some numbers around that, we have about $165 million today of embedded NOI growth within our portfolio. And about 65 million of that is coming from our repositionings and redevelopments that are either in process today or in lease up. So that's near term embedded NOI growth that will drive significant NOI. And add to that our rent steps. We have annual embedded rent steps of 3.7% in our leases. And so that's another significant lever of growth. So without our business model, and this is where we're super fortunate, is not dependent on market rent growth. We've seen some pressure on market rent growth over the past couple of years as the market's normalized from COVID, those pandemic highs. And even in that normalization period of market rent growth, we've still been able to achieve positive growth within our portfolio and still have significant embedded growth of about 23%. That $165 million equates to 23% embedded NOI growth within our portfolio. And that's the core of the Rexford business model.
This NOI growth and these numbers that you're talking about, I guess on a, maybe stepping it back a little bit, what does that mean in terms of FFO growth? I know we're focusing on the bottom line, but what does that mean, I guess, on the incremental FFO growth side of the equation?
Yeah, that's all incremental FFO growth, a full 165 million. And that's 65 million. Let's just talk about the building blocks right there, because that's mostly that is near term that will come online over the next 2+ years. And I would say
Fitz, for a dumb guy like me, what is that like on a per share basis?
on a per share basis, you're looking at, for the 65 million of NOI, for example, you're looking at about, you know, 28 to 30 cents per share.
And these are estimates. Again, we're
Yes,
not holding the
right.
company, you know, on the line here. But again,
Yeah,
okay,
so
so good estimate there.
it's a significant amount of embedded NOI growth that's ahead for the company. And let me break it down for you just to kind of give you credence and some support that it's going to come on near term. You know, 12 million of that 65, David's already stabilized. It's going to come online in the fourth quarter. We already have signed leases. And then there's additional 30 million, round number, that is tied to projects that are already complete. The building's already constructed, no more development risk. We're just waiting and working hard to lease it up. We have 75% of leasing activity on those spaces, whether it's lease negotiation or LOI negotiation. And then the remaining 25 million, which will come on probably later in 26 and 27, is where we have projects that are under construction. So this is all near to midterm NOI growth that we expect to harness over the next 2+ years.
Sounds pretty powerful, actually. All right, so jumping ahead a little bit, and I know I briefly teed it up. Fitz, this one's all you. I'm sorry, man. Just from where I
No, sorry,
sit,
no, it's good. I see a big wall there. I see a bar that doesn't look
Slide,
like the
great
others.
slide. Yeah.
soothe me about 27 and beyond, my friend.
Yeah, no, let me just take a step back and just talk about, what our guiding principles are, and then I'll answer your question directly around the maturity ladder that we're facing in 27. We believe in low leverage, we believe in high liquidity, we believe in flexibility, we love the unsecured capital structure. Well staggered maturity profile. We got to stagger it a little bit better here, which is the opportunity. Access to capital. I think we've proven over time we have all access to all types of debt and equity, and no floating rate risk. And I think you can look at the left side of the page, and I think that's we're sitting pretty right here. I think the one thing that is slightly lower expectations is the duration. And a big driver of that is the $1 billion that's coming due at about a 4% rate on a weighted average basis in 2027. The good thing is that there's no target in our back now to do anything. We do have time to be strategic about this and really balance duration and rate as we look to refinance that. But we're already strategizing around how we're going to refinance that billion. For example, 300 million of that billion is open at par. I can refinance that today. It's just under a 4% rate. So you could see us likely take some chips off the table in early 26 and be opportunistic, whether in the public bond market, the convert market, the bank market. We have plenty of markets that we can access, and we'll look for, again, a balance between rate and duration. And then the additional 700 million is really tied up until the first part of 27. And again, what we will be balanced with duration and rate. And again, we have access to all types of capital, and we look forward to ensuring that we stagger this a little bit better. Our goal is to have no more than 15% of our debt coming due in any given year. And if you look out at 2032 and 2033 and 4 and 5, there's a lot of space to be had here for this billing to be put right in those spots in the ladder.
For those that don't follow the REITs every single day like you and I, the one thing that we know pretty well is how wide open the debt markets are right now. The lending window is wide open.
Yeah,
It's not a problem to take down that money, as you
You're
said.
you're absolutely correct. And we have 12 banks in our line, headlined by JPM and Bank of America, to name it, top two, left lead and right lead. We're widely supported. David, we recasted our credit facility and our term loans back in May of this year, and we had a waiting list of banks that wanted to be supportive of us. We're very grateful. We're very fortunate to have that support. They are our big time allies. They are partners to Rexford, and we will utilize that going forward. But like the term loan market is wide open. What is new to the term loan market now? They're offering 7-year term loans. which is incremental, longer duration that is come to market as of late. The public bond market is, I would characterize as been on fire all year long. Spreads are as tight as they've ever been. All-in rates are definitely reasonable. And you're seeing more and more come to the market. Today, Highwoods came to the market. So
And we had two yesterday with
yeah.
EPR Mid-America. So yeah, it's wide
exactly.
open.
And the convert market's also there too. I mean, it's cheaper debt. There's a lot more considerations going into that with where your stock price is trading, but that market's also alive and well too.
Look, dumb question again. I don't know anything. How about institutional partners? Does Rexford have JVs with sovereign wealth? Is that phone ringing to do JVs with sovereign wealth? What does that look like?
Yeah, it's an opportunity for sure. We always have those high level discussions to see if that capital makes sense for Rexford. Today, we're 100% wholly owned. We got a pretty clean balance sheet. We do like it that way at this point. And look, I think the disposition progress we make and the attractive currency that is creating for the company, where we can sell assets in the low 4% cap rate area to raise capital, that's the best option today. I think JVs will always be part of the discussion, the strategic thinking, but in terms of prioritization, it's not a priority today, just given our access to all types of debt capital plus the disposition progress that we've made to date.
So what about, I know we've thrown a lot of stuff out there, talking about this NOI growth, but I guess more importantly, talking about the dividend safety, dividend coverage, keys to dividend growth.
It's a great question. The quick answer is a dividend safe yes, right? And I think that starts with our strategy. We, as you said, as Laura said, we're arguably in the best industrial market in the world with severe supply constraints that will enable us to grow value for our shareholders over time. We have multiple levers, as we discussed, to increase cash flow growth. We have sound balance sheet philosophy, low lever, high liquidity, investment grade rated. We have a healthy payout ratio. We're in the low, on an AFFO basis, we're in a low 80% range. And look, lastly, we have a track record of growing dividends. If you look at the last 5 years, 15% on an annual basis. And as we look forward, we'll continue to grow our dividend with earnings growth. And we've talked about all the levers that we can pull, to drive FFO per share going forward. So we're very confident in the dividend policy today.
So my last two questions, I'm going to ask them to both of you to answer them separately, since you both wear different hats.
Mm-hmm.
First question: what keeps you up at night these days?
I'll answer first, and maybe I'll take Fitz's answer. Sorry, Fitz.
That's right.
David,
Kids, family does not count as an answer. Staying up late to watch the Dodgers, that doesn't count as an answer.
Staying up late to watch an 18 inning World Series game. But besides that, look, David, for me, it's always the same for me. It's the team. And it's thinking what keeps me up at night is our team, because the one thing that I know is our team is the number one factor to the success of Rexford as we move forward. So it's thinking about the team, their engagement. Do we have the right people in the right places? How are we thinking about process? How are we thinking about innovation, and how do we drive further excellence and efficiency within the business? Because that is number one to what's going to allow us to continue to execute on our great business model.
Yeah, and look, Laura and I are, one, great partners. Two, we think a lot alike, a lot of different subjects, and team for me as well. I'm a huge team guy, and just making sure that they're, to Laura's point, engaged, motivated, empowered, and being the best version of themselves is what I worry about. Just the same way I worry about my own family, right, and my kids. I tend not to worry about the things I can't control, David. I can't control the macro headlines. I can't control tariffs. I can't control interest rates. But what we can control is promoting and recognizing and empowering this team to deliver on our strategy. And we're confident that they can do that. It's just making sure they're always positioned to do that, and offering our support, because at the end of the day, we serve our team.
We have a listener question that came in, and I think it kind of plays in towards, the last question and looking at the value proposition. Why do you think there's a disconnect between the fundamentals performance and the market reaction to that, the market acceptance? Why do you think what do you attribute a disconnect to there?
Yeah, look, we have been, I mentioned it, we've been in a period since, let's go back to the pandemic. We went through a period in the pandemic where market vacancy got to 0.5%, obviously not sustainable levels. We saw market rents within our portfolio grow about 80% within a period of about 2 years. So we've seen that normalize, where we've seen market rents reset and decline about 20% over the last couple of years. What we know is that there is a very strong correlation between market rent growth and your stock price. That correlation is over 90%. And so even though fundamentally we talk about our tenant base, we talk about the demand and supply dynamics within our market and how favorably we are positioned, our repositioning, redevelopment, the embedded growth in our portfolio, 23% NOI growth embedded in the portfolio. All that being said, as we've gone through this period of normalization within the overall market, that has put pressure on overall, current, and the current valuation on the stock price perspective. But all that being said, you can go back to all the comments that we made about, the embedded FFO growth in the portfolio, regardless of market rents. And we are seeing, as Fitz said, we are starting to see more demand. We are seeing, the leasing activity in the third quarter demonstrates that. Certainly not at the point where we want to call a bottom, but we even saw, slower decline in overall market rents as well this past quarter. So fundamentals are the market overall is in a position to be able, given the demand and supply dynamics, to be able to grow from here as we see demand and incremental demand come back into the system. The other thing that I will say, obviously the overall macroeconomic environment is a big piece of this. Tariffs, and we talked about it earlier today. There has been tremendous volatility, obviously, and overall tariffs since April 2nd. What is the policy going to be around tariffs? What's the level of tariffs going to be? There's been a lot of starts and stops there. And it quite frankly is very challenging for businesses to make decisions in that state of volatility. And so, that has impacted overall decision making. We saw some improvement in that in the third quarter, but that volatility could continue to impact incremental demand in the near term.
What do they say? Volatility equals opportunity, right?
Yes.
So, yes. I will open it up for Q&A if anybody has any questions. Scott, I got you there. Anybody else would like to ping Laura Fitz? Now is your chance. And if not, I will say we've talked about a lot of stuff over the past 45 minutes. And you've thrown out a very compelling argument or case as to why Rexford, looking at the embedded NOI growth, the opportunities, the market, not institutionally owned by and large, all of these things. So I guess if you had to put a couple of bullet points together to put a pretty little summation of all of this, again, why Rexford? What's the value proposition looking out for beyond? Again, for the investor that focuses on dividend coverage, which you guys have focused on, the leverage concerns, which you guys have addressed here. We see what that market looks like. What would you, I guess, hammer home as the true value proposition here?
Dave, I'd focus on a lot of the areas that we've already touched on. I think the value proposition starts with our business model, which is, how we take a building, how we make it more functional, how we drive the quality of that building that allows us to drive more demand than other buildings within the market and allows us to drive higher rents. Because we're delivering a product to the market that allows our tenants and other tenants in the market to more efficiently and effectively run their businesses. And when they can do those two things, they can drive higher revenue, and they can pay higher rent. And so first of all, it's the positioning of our portfolio in the market in terms of owning the highest quality, highest functional product. And then we continue through our business model of acquiring over time those assets that have been undermanaged and undercapitalized, and being able to execute time and time again that value creation strategy. The other thing we haven't talked about that I'm really glad you brought up this question, because I think it's one of the most important things. And I talked about the team, but our team here differentiates our performance. We are a vertically integrated team. And what does that mean? We have on the ground property managers, we have on the ground leasing team, we have on the ground construction and development management team. We have in-house investments, marketing. I could go through the list, but we have a team that's focused in one market. We are experts in this market. We understand what the demands are in this market on a block by block basis. We know what product to deliver. We know what product not to deliver, and we know what those tenants need to better run their businesses. And so to be able to proactively drive demand because of that knowledge base and that expertise positions us very differently in the market. And you've seen that. If you look in the third quarter, we drove 1.9 million square feet of positive absorption in the market this quarter. The overall market, that's 1.7 billion square feet, was nominally positive, about 400,000 square feet. So what we're seeing is that not only is the quality and functionality of our product driving better demand, but our team is a significant driver of that. And having that on the ground expertise is something that continues to widen the moat around Rexford, is how I like to characterize it.
When you guys do the holiday party, do you hang out one of your properties to get everybody together under one roof?
I will say we get the team together all the time. I think we're so lucky because the team here, our team all lives and works in Southern California. We have a team of about 250 amazing individuals. And so being able to have a team that's all in one market means that we get to spend a lot of time together, whether it be at our properties, whether it be in the office, whether it be in outings. We're really fortunate.
Will we be seeing Shohei Ohtani as a spokesperson for Rexford in 2026?
I don't know if
Only
it's
if he's willing to do it. Only if he's willing to do it for free.
Yeah, there you go.
Then yes.
We could possibly work on that.
Okay.
Fitz, Laura, I can't thank you enough for a very informative and insightful 45-minute conversation today. Obviously, as I mentioned, if anybody has any questions, please feel free to reach out to us. We will get your questions answered. But on behalf of the Hoya Capital audience and anybody watching this, thank you again for giving up time of your day today to share your thoughts with us.
Thank you so much.
Thanks, David.
Stay with me 1 second, Laura. Don't hang up on me real quick.